Hello, my name is Moises Rodriguez, and the purpose of this video is to talk about test taking strategies, specifically using the sample final for the capstone class. And so this is specifically designed for those students. Now, I usually divide test taking strategies into three categories. Obviously, easier said than done, staying calm and being strategic. Following the counterintuitive, which is looking for the wrong answers and eliminating those to the extent possible first. And thirdly, identifying a key word in the question that actually differentiates the rest of or one answer from another. This keyword many times can help you eliminate at least two of the potential answers. Now, in this particular case, you have a large amount of questions, close to 80, which is more than double of the questions that a lot of the finals are currently. So being strategic is that much more important. Now, I usually tell all my students to try to identify or develop a game plan, when they're going to take it, where, to make sure they're going to have 3 hours of uninterrupted time, to find the most comfortable circumstances to take it, isolated, hopefully in some place where potentially you even have more than one monitor. Because what I highly encourage is that the idea is use your slides, use your notes, have everything ready. The other thing is obviously you need to have the right mind frame. There are courses where there's so much homework due on week 5 or 6 that by the time you take the final, all you want to do is get it over with. And so you're tired, you've lost all your patience, and you just want to sometimes just go through the motions. And I warn you against that. Now, that's the strategic part. The staying calm obviously is easier said than done, but a lot of this is going to be based on just having confidence in a system that I'm going to talk about, and just knowing that if you follow a system, you're going to have enough time to complete the exam and follow this process. Now, when we talk about staying calm, the main thing that I want you to try to adhere to is don't jump at the first answer that appears to be correct, okay? And in order to feel that, or to actually have enough time, you're going to need to have some time management. Now, having said that you have almost 80 questions, that means in a period of 180 minutes, you're going to have just a little bit over 2 minutes on average a question. I usually recommend students to break this down into 3 categories of questions: the simple, the questions that are of medium difficulty, and the difficult questions. Now, considering the volume, I would highly suggest that you limit answers to questions that are of relatively low difficulty to around a minute or so. What that's going to do is, if you do that, the questions of medium difficulty, you're going to be able to allow maybe 2 minutes or perhaps a little bit less, because again, you have so many questions. This will in fact allow you, and you'll have to compute the actual percentages, but it'll allow you more than 2 minutes for the questions of higher difficulty. Now, I strongly recommend that if you're struggling with one question, you spend absolutely no more than 5 minutes on it. As a matter of fact, the other thing that I tell students is that many times, if we just move on to the next question and just keep going through the exam, just making a note, mental note, to come back to the question we skipped, it's quite possible that we'll find a question that actually helps us answer the question that we were struggling with. And so that's part of the belief and confidence of this system that you follow and that you'll be able to get through this in a good shape. Okay, so having talked about the first criteria, let's now go through the questions. And in this case, I'm just going to cover finance, accounting, and economics, and follow the next two suggestions that I made, which is try to eliminate as many questions as possible. This will help you increase the probability of you ultimately getting the right answer. And then also, in order to do so, try to identify the key word of each question. This will help you actually differentiate the meaning of some of the answers. Okay, so what I'm going to do is I'm going to start with question number 34. That's the beginning of the finance section, which is located on page 8 of the sample final. And the question is, pursuing valuable ideas is the best way. Now, the first thing that I'd like to do is let's try to identify what the key word is. To me, the key word is valuable. And so in finance, we want to add value, but finance also involves a balance between risk and return. So let's take a look at the possible answers, but keeping in mind, we don't want to jump at the first answer that appears correct. Rather, we want to look and aim to eliminate questions that are just wrong. Okay, so A is to achieve extraordinary returns. Well, to be honest with you, that is a goal of finance, so that does not appear to be incorrect, but I don't want to jump at that. Let me go on. To get yourself in trouble. Well, does that really mean, does that make sense? Would that add value? I don't think so. So I think we can eliminate that one. To restrain your spending. Well, when we're in financing, we are going to spend. The question is, how well are we going to spend and how smart are we going to make decisions in that spending? So I don't think that's actually what they're looking to accomplish. And D, to avoid risk. Well, I mentioned that finance is a balance between risk and return. You cannot eliminate risk altogether if you're going to produce value. So having gone through all four, I think we can safely eliminate B, C, and D. And that really increases our chances of getting the ultimate answer correct, which is A. 35. An investor's risky portfolio is made up of individual stocks, which is the following statements about this portfolio is true. Now, what is the key word? To me, the key word is risky. Now, if you're going to invest and you're looking to make money and increase value, there has to be some risk. The question is, how do you mitigate that? Well, many times, if it's going to be stocks, you buy stocks in a portfolio that are diversified, meaning that they have different levels of risk and different kinds of risk. And so here, what we're talking about is that this portfolio has an overall high level of risk. And yet, what we know is that to mitigate this risk, or I think an inherent assumption, is that the different stocks within the portfolio are going to have different levels of risk, perhaps in the opposite direction. Okay, so the beta of this portfolio is negative if all stocks are positively correlated. Well, the truth about this is that you really don't want a portfolio with stocks all positively correlated. If you're going to diversify, you want stocks going in opposite directions so that you can mitigate a strong turn in the market. And so that's probably not correct. As a matter of fact, I would strongly argue that we could probably eliminate that question at this point. B, all of the stocks in this portfolio will have a beta greater than 1. Well, having a beta greater than 1 is a large beta. But again, because of the inherent diversification, we're going to want stocks with diversification going in different directions, some positively going positive, some negative, but also with different betas. And so to say that all stocks are going to have a beta greater than 1, I think would be an incorrect statement if we're trying to mitigate risk. All stocks in this portfolio will have a beta less than 1. Again, the inherent diversification in this portfolio, I think, makes this statement wrong. So I think we're left with D. 36, which of the following represents the perfect capital market view of capital structure? And I would argue that the key word here is perfect. Is there anything that in this world that truly is perfect? Well, I guess that could be a point of argument, but let's look at some of the answers. The value of the leveraged firm is equal to the value of the unleveraged firm plus the tax rate times the amount of debt. Well, actually, while all these factors come into play, the truth is that we're looking for a multiple effect by using debt. And so that can give us a much greater impact if we're successful in using debt. But using the tax rate times the amount of debt is really not the way to determine how much additional value is going to be created. As a matter of fact, the only way to know is to find out in reality what your total results were, because the more debt that you use, the more sales volume that you're going to need to get you over the hump. Okay. Corporate taxes cause debt to be cheaper than equity. Well, this is a true statement by itself. Corporate taxes cause debt to be cheaper than equity. Why? Because you get a deduction for interest. Okay. But then let's go back to the question, which of the following represents the perfect capital market view of capital structure? Capital structure is your mix between debt and equity. And so I think that when we focus just on the cost of equity versus debt, that's only isolating one aspect of identifying what I would consider the most appropriate capital structure for the business at specific facts, under specific facts and circumstances. So I think that doesn't quite get there. C, maximum firm value results from being essentially all debt finance. Well, again, capital structure is that balance between debt and equity. So especially in today's environment, I think it's unrealistic to just assume that you can go and be 100% debt finance. That is not really a recommended capital structure, certainly not the perfect. And so I think that by default, we're left with D. None of these really meet the perfect definition. And if we would have identified the keyword perfect, then we knew from the very start it was going to be very hard for any answer to actually meet this goal. Okay, 37. Bank term loans represent. Okay, so when we're talking about bank terms, this is the agreement that we sign. Let's look at the and so I would say that the key word here is term, because term loans are a very specific kind of loan that identify a lot of detail as far as the term of the loan and a lot of other conditions. Okay, so A is long-term loans that look like short-term debt. Well, term loans are for a specific term, doesn't necessarily, and it's not likely to be long-term loans. Loans for specified amounts that require borrowers to repay them according to specified schedules. That certainly sounds like a term loan, but I want to avoid just jumping at that answer. Let me go on. The pledge of receivables. Well, that's not really a term loan in all of these. Well, we were able to eliminate at least C and most likely A. So D is not going to be the answer. And so not having jumped at B, but getting a reconfirmation that C and D are not the adequate answer just gives me more confidence that B is the correct answer. Okay, 38. Blank says to calculate the net advantage of a foreign project on the basis of the incremental after-tax cash flows the project will provide. Okay, so what is the key word here? To me, it's incremental, all right? Because we're looking at advantages on an incremental basis. Now, they're looking at cash flow, and that's important, but I think ultimately we're still going to resort back to looking at the net benefits on an incremental basis. Okay, so A, the behavioral principle. Well, I'm not sure that the behavioral principle is even applicable in finance because if I were talking about economics, that's about human behavior, but I don't know that the behavioral principle would apply here. The principal comparative advantage. Now, I know for a fact that that's really international trade and a term used in economics. So I can say that comparative advantage has to do with specialization and what you're best at. Okay, that just doesn't seem to fit on the concept of incremental. Third, the principle of incremental benefits. Well, that certainly sounds good. Okay, it seems to fit all the criteria that I'm looking for, but let me go on to D, time value money principle. Well, if having worked with the time value money principle, you realize that a lot of it has to do with net present value and so forth, that at this point doesn't seem to enter into the equation here. So I think by having gone through all four answers, we're back and can get additional confidence that C is the right answer. Number 39, which of the following forms of ownership are purchased in capital markets? Okay, and so what's the key word here? I think it's capital, because we're looking at markets, but it's capital markets. Well, what's capital? Okay, it's going to be some sort of capital investment. So let's look at A, stocks. Well, that certainly sounds like the right answer, but let's go through the other ones to make sure. Bank debt. Well, that bank debt is not capital. Okay, that's debt. Computer equipment. That's not capital. And D, research and development. That's not capital either. So now I think I certainly feel a lot more comfortable in saying that I've eliminated B, C, and D, and that A is actually the right answer. 40. The principle of blank implies that the expected return for an asset equals its required return. Okay, now, what is the key word here? And to me, it's expected, all right? And the reason why I think expected is the key word is because inherently, when you invest money, there is a risk-return trade-off. And for every investment, once you identify the level of risk, then there's going to be a related return that is inherent in that kind of investment. And so let's look at the potential answers. Capital market efficiency. Well, that certainly sounds like the right answer, because you are looking at a return for an asset, which means that effectively the asset is part of the capital that you've invested, okay? And you want a return. But let's go on. The risk-return trade-off. Well, the risk-return just says there's going to be a relationship between risk and return. It doesn't tell you what the expected return is for a certain level of risk. Comparative advantage for C. Again, this is an economic concept based on international trade, relying on a form of specialization. And D, signaling. Well, I don't even know what they really mean by signaling, so I think that we can eliminate that one. So by having gone through all four, I think now I'm more confident that I can go back to A and say A is the best answer. 41. Blank says to look for opportunities to develop derivatives that enable firms to cope better with the financial risk they face. Now, derivatives has a negative connotation, okay? And so, especially the way that they've been applied here. But derivatives can also be used for hedging, okay? And so in that context, let's find out what the keyword might be. And to me, it's a toss-up, but I would go with cope, because what they're trying to do is coping with financial risk, which implies to me mitigating financial risk, okay? And so given that premise, let's go and look at the answers. A, incremental benefits. Well, we've already applied that in a different context, so I think we can eliminate that. The B, the principle of valuable ideas. Well, that doesn't sound so bad, because the truth is that anything that helps us mitigate risk is actually allowing us to earn a return with hopefully less risk. But let's keep going. The principle of two-sided transactions. That sounds more like accounting to me. And D, the behavioral principle. Again, I'm not even sure that that really applies in economics, finance, or accounting. So I think we're back to the principle of valuable ideas. That seems to be the best fit. Okay, now, which of the following statements is false? Number 42. So the key here is, to me, the key word is false, meaning that we're looking for the answer that we're looking for is a statement that's true. So if we're going to follow this process of first eliminating the wrong answers, then we need to identify the answers that are true statements. Okay. Okay, so A, like a call option, a warrant specifies the underlying common stock, the number of shares, the strike price, and an expiration date, and the option type, American or European. Well, to me, that's a true statement. So that's not an answer that we're looking for, because the ultimate answer is a false statement. So I think we can eliminate that one. Dividing the face amount of the convertible bond by the conversion price gives us the conversion ratio. That's the way I do it. So again, this seems to be a correct answer, a correct statement, excuse me, and therefore an incorrect answer. Number C, convertible preferred stock is usually perpetual, whereas convertible debt has a stated maturity and usually has a sinking fund. Now, one thing to keep in mind here is preferred stock is a form of equity, whereas convertible debt is a form of debt with certain equity components. So would it make logical sense to say that preferred stock goes into perpetuity? I think the answer is yes. simply because by its nature, it's a form of stock. Now, would convertible debt have a stated maturity? The fact is that it's got debt, and it's only upon your election to convert it into equity where that it would no longer be debt. And if you never make that, then there needs to be incorporated a stated maturity date in that event that you never elect to convert. So again, I think this statement is true, and therefore the answer is false. I mean, I'm sorry. I think the statement is true, and therefore this answer is incorrect. Let's go on to D. Conversion of perks into common stock is voluntary, not mandatory. And now, here's the thing, that we don't even have to discuss what specifically a perk is. The fact is that we've gone, and we could certainly Google it real quick, but the fact is that we've gone through A, B, and C and found out that these statements are true, and therefore that they can't be the right answer. Okay. All right. 43. Which statement is true? Okay. Now, again, I would go with the keyword being true. And so the right answer is a true statement, and we're looking to eliminate answers that are false statements. A. Principle of comparative advantage states that capital market efficiency allows firm to concentrate its primary efforts on its comparative advantage rather than on a day-to-day financing. Well, while I find the term comparative advantage used more in economics, like I said before, comparative advantage does deal with specialization and devoting your time to what you're most efficient at, and devoting your time in a manner that's going to produce the highest amount of value. So this statement certainly sounds true to me. B, the principle of signaling states that new ideas can provide value when first introduced, even in an efficient capital market. Well, first of all, I would, without even getting into the principle of signaling, okay, just the condition, even in an efficient capital market, the truth is that you would expect to produce even more value in an efficient capital market. And so right away, that gets me suspicious about this answer. But the principle of signaling is not something that I feel that is appropriate in this statement. Okay. The principle of valuable ideas suggests that self-interested capital market transactions force market prices towards being fair prices. Well, this sounds more like an economic statement, but I don't like the word force, because this is supposed to be a process based on the invisible hand that simply is a give-take situation that ultimately results in a negotiated and agreed upon price between buyer and seller. And then none of these. Well, I think that if we go back to A, that sounded good to start. I certainly don't think it's an incorrect statement, and therefore I can eliminate D. I've already taken exception to B and C, so I'm back to A, and that's the answer that I'm going to go with. Okay. 44 is a mathematical question, and essentially what they're telling you is, I'm not going to read the whole thing. It's you own 200 shares valued at 20. The total shares outstanding are 20 million. They're looking to increase the number of shares by 30%, which would be 600,000. Okay. No, excuse me. if we have 20 million, we're going to increase a 30% increase would be 6 million additional shares. Now they're telling you that the value is not going to go up or down, all right? That it's going to basically maintain the same value because in terms of the total company, it's just that effectively the additional. No, let me go back. I'm sorry, I have to correct myself. The value, the stock is not going to go up or down. Okay, so the $20 is going to stay the same, and essentially the value of the company is just going to go up correspondingly by how much you sell the stock for. So the value of the stock is going to stay the same. And the question is, what's going to be the cost of doing this? And they actually hint to you that the impact on value will simply be the issuance cost. Okay, so in this case, it's just a mathematical equation of taking 20 million times 30%, which is 6 million. Okay, and the cost is going to be 10% of that issuance. Okay, 600,000, and then you take that times the value of the share, which is 20. Okay, now if you go through that math, what's going to happen is that you're going to get 600,000 times 20, all right, and then you multiply that times the ratio of what this investor has relative to the total shares outstanding. And so he's got 200 shares compared to 20 million. All right. So if you do the math, then you have to divide by 100,000. If you do all that, it'll get you to $120. And basically that's going to be the impact, because again, the only impact is the cost of the issue of issuing. Number 45, which of the following is not a disadvantage of going public? Now, what we're talking about is an IPO. All right. So here they're stating two negatives. So if we could do that and just convert that into the two negatives into an advantage, meaning that the correct answer is looking for an advantage of going public. Okay, meaning that we first are looking for answers that are not an advantage. We want to eliminate all the answers that are not an advantage. Okay, so A, going public involves significant expense, generally 6 to 13%. Well, that's certainly not an advantage. Okay, so I think we can eliminate that. Going public can take a substantial amount of valuable management time. Well, that's true, but again, that's not an advantage. So I think we can eliminate that. Okay. Going public lessens estate tax obligations. Well, that's totally irrelevant. That has nothing to do with going public. And D, going public can cause existing shareholders to lose voting control. Okay, so that's also a true statement, because you're opening up for other investors, and so you're going to lose the percentage of your share of ownership. Now, let me clarify this question. They're saying not an advantage, so I incorrectly told you that it had to be an advantage. It just doesn't have to be a disadvantage. And so in this case, we identified A as a disadvantage, B as a disadvantage, and D as a disadvantage, and C is irrelevant. So this is a tricky question, but the answer is C because it's not a disadvantage. Okay. Now we're going to go into the accounting section. Number 46, which of the following is a cost that's not likely to be associated with computer integrated manufacturing. Now, what's the key word here? To me, it's computer. If we talk about a manufacturing environment with computer, then we're either talking about automation or robotics, and which would go against using direct labor. So what we're looking for here is something that's not part of automation or robotics. Okay, so what we want to do is identify all answers that are associated with automation or robotics. A, manufacturing overhead associated with allocation of equipment depreciation. Well, using equipment is certainly a part of automation, so I think we can eliminate that. B, direct labor costs of a welder on the production floor. Well, that goes against the grain as far as automation or robotics, and so that certainly might be the answer, but let's go on. Manufacturing overhead associated with the allocation of plant lease to the latest production run. Well, when we talk about plant lease, okay, all those are overheads that are not necessarily telling you that there's a lot of automation, but when you have overheads, okay, overheads are indirect costs. When you have labor intensive operations, you have direct labor. So while it's not clear, I think the fact that they're focusing on manufacturing overheads leads you to believe that there's a lot of indirect costs and there's more automation. Then finally, D, direct materials costs with several fuse plates for a new automobile. Well, the fact is that whether you have a labor-intensive operation or an automated operation, you still need direct materials. So that really does not necessarily give you the information as far as whether that's labor-intensive. And while it's not telling you that it's automated in this case, it's really not telling you that it's labor intensive. And so I think by default we go back to B, okay, that it's not, that's clearly the best answer to indicate that that's not associated with computer integrated manufacturing. 47, if a plant is operated at full capacity and receives a one-time opportunity to accept an order at a special price below its usual price, then let's think about this. What's the key word? To me, capacity. It's already at full capacity. If you're already operating at 100% or full capacity, why would you even be considering taking on additional orders, much less at a lower price? So let's try to find answers that really do not fit this situation, because right off the bat, if they're offering us a lower price, then we're likely to reject that offer. So let's look again, before jumping to an answer that looks right, let's try to eliminate answers that are probably not right. Okay, only variable costs are relevant. Well, that's not true. We need to consider fixed costs as well. Fixed costs are not relevant. That's not true. Okay, the order will likely be accepted. Well, that's not likely to be true either, because we're already at full capacity. And so by default, we're left with B, which is what we expected in the first place. 48. Texas Manufacturing Company can make 100 units of a necessary component part with the following costs. Okay, now, if Texas Manufacturing Company purchases the component externally, $15,000 of fixed costs can be avoided. At what external price for the 100 units is company indifferent between making or buying? Well, the first thing that we need to do is find what the per unit costs are of each cost. So we can see that if we divide all of them by 100, direct materials is 600 per unit, direct labor is $100 per unit, variable overheads is $300 per unit, and fixed cost is $200 per unit. Okay, so if we add up the math with the exception of fixed costs, we get $1,000. Now, we're saying that we can reduce the fixed costs to 15,000, or excuse me, that 15,000 can be eliminated. And so we know that with variable cost, if we don't use it, we don't have to pay for it. With fixed costs, we do. So here's what we are looking at. We're looking for total avoidable cost if we outsource it. We can avoid direct materials and direct labor, which add up to $700 per unit. We can avoid $300 per unit of variable overheads. That's $1,000. We can also avoid $15 per unit of fixed overhead costs. That adds up to $115. When we take that times the number of units, no, I'm sorry, I apologize. That really adds up to $1,150. 300 plus 200 plus, I'm sorry, 600, 100, 300, and then 150 adds up to 1,150. We take that times 100 units, and that gives us 115,000. Okay. Transfer pricing. Now, should be said in a way as to, I think, transfer pricing, by the way, is a methodology to try to assign to the best possible level the actual fair market value of what a unit is worth upon production. This is done so as to avoid under-reporting sales many times by another entity, especially if they're in another country. Okay, so knowing that, what we're looking for is something that's most reflective of how much the cost would be under an economic analysis. Now, the transfer pricing, okay, is not going to be the sales price, okay, because they're not the ones as the ultimate seller, and you got to remove a certain degree of markup by the parent company or whomever is going to do the final sales price. So typically there's an inherent markup, but it's not going to be all the way to the full sales price or final sales price. Okay, so transfer pricing should be set in a way as to discourage the internal sales of a goods and service. No, quite honestly, transfer prices are established to better reflect sales between related parties or internal sales. B, reflect the actual costs, including opportunity costs of the transfer. Well, that certainly sounds correct, because the opportunity cost is reflective of an embedded profit that the entity that's doing the work would receive, but it doesn't include it doesn't reflect the final sales price, because many times the parent is going to do repackaging and they need to have a certain markup that leads to the final sales price. C, eliminates profits on the transfer. Well, we just said that there needs to be some profit margin for the entity that is producing this product, so that's not true as well. Reflect market prices. Well, we said that we're not going to actually go with the final sales price, because that is going to be left for the final entity that does the sale. And so that's not true error either. So we're left with B, reflect the actual cost, including opportunity cost of the transfer. 50. Tucson Corporation has a joint process that produces 3 products. Each product may be sold at a split off or processed further and sold. Joint processing costs for a full year amount to 100,000. Other relevant data are as follows. Well, sometimes they give us more information than we need. The question here is, once product is produced, further processing further will cause profits too. All right. Well, the thing is that we go from a sales price of 128 to 160, which is 32,000, but we're going to incur an additional 16,000. So essentially it would be 32,000 incremental sales price less the additional cost of 16 leaves us with 16, or D. 51. A blank gives the expected sales under a given set of conditions. Well, what's the key word here? I think the key word is expected. It's not a prediction. It's not a for sure. It's just kind of what you think it might be. Okay, so is it a prediction? A, no. Is it a sales budget? Well, actually, that really sounds like the right answer, but let's go on. C, budget forecast. Well, the thing is that an entire budget is comprised of sales and expenses, and so the budget is a complete budget, and here we're only talking about sales. D, sales forecast. Now, I'm sort of torn between B and D here because there's a slight difference between a budget and a forecast, and that's simply that a budget is typically for 1 or 2 years. A forecast is typically for 2 to 5. And so it's sort of a toss-up. I have to tell you there's only one thing, that if we go back to the keyword expected, all right, then I think it tilts towards the word forecast versus budget, because budget is something that you're budgeting. Forecast is something that you're calculating and based on what you anticipate. All right. 52. The projection of financial position at the end of the budget period is found on. Okay, so what's the key word here? To me, it's position, okay? Because position is something stationary, okay? Fixed. And if we were looking at any statement that is based on a position, it would be the balance sheet. And we're projecting this, okay? And so the other thing is we're talking about something at the end of the budget period, meaning that a state in time. So it's certainly not the income statement. All right, so let's take a look. Budgeted income statement. Again, that's a flow approach, not at a state in time. Cash budget. We've not said anything about cash here because the statement for cash is cash flows versus at a point in time. C, budgeted balance sheet. That certainly sounds right. D, sales budget. Well, here again, we go back to the keyword position. And therefore, the best answer is C, because when we talk about the keyword position, we're talking about something stationary, fixed point in time, which is a balance sheet. 53, Black Company planned to produce and sell 900 units at original cost of $100,000 to $80,000. Actual production was 900 units at a cost of 170. Well, here, basically, one is a comparison of budget versus actual. We see that the production was the same, but at a lesser cost. So we're looking, we basically had a favorable variance. And by favorable variance, that would infer efficiency versus inefficiency. Let's take a look at the answers. A certainly looks good, but let's go on. Inefficient. Well, that's not what we had as results. Effective? Well, it was effective. Okay. The question is, which is the better answer? D, ineffective. No, the results were effective, but by accounting terms, efficient is the better answer. 54, cost behavior analysis applies to. And the truth is that in this case, to me, it's like the key is analysis. And I think that when we're talking about cost accounting, analysis should be done for every operation. So as we look at the answers, retailers, wholesalers, manufacturers, and all entities, I think clearly the answer is D. 55, a company sells a product which has a unit sales price of $5, variable cost of $3. Okay, fixed cost of $120. These are mathematical, so I'm going to go through this pretty quickly. All you have to do is go by the formula. You got a contribution margin of 5 less 3, or 2. To cover the fixed cost of 120, you take 120,000 divided by 2, and you get A. 56, the amount by which actual or expected sales exceeds break-even is referred to. Okay, if we exceed the break-even point, we're going to have profit. Okay, and you can either call that profit or margin of safety. Now, here we've got a, let's go through the answers, okay? Contribution margin, well, that's not really it. Contribution margin is the difference between the sales price less your variable cost. Unanticipated profit, well, gosh, let's take a look. Let's go back and read the question. The amount by which actual or expected sales exceed break even. It really, in this case, because we talked about expected, all right, then it wasn't unanticipated. Margin of safety, well, if we have expected sales to exceed break even, we could say that's a margin of safety. And indeed, targeted net income. Again, let's go back. If we have expected sales to exceed break even, all right, then that could be a form of target net income. Now, the question is, we've eliminated A and B, but we're kind of hanging in the balance between C and D. And the question, if you look at your accounting books, okay, a lot of times you'll see that there's a specific calculation for a margin of safety. And so it's more often than not that you actually build in a margin of safety than targeted net income, in light of the fact that you're looking at break even. And when you're looking at break even, you're simply doing these calculations with the primary focus of avoiding loss. So margin of safety is more in line with that than target net income. Okay, 57. There's no evidence between variable costing and absorption costing income if there's no. Now, perhaps you need to Google what the difference between variable and absorption costing, and I'll tell you that one has to do with how you categorize your fixed and variable costs. But at the same time, the truth is that typically this doesn't make a difference if your inventory levels stay the same, because the truth is that one method versus the other will basically shift more cost to cost of goods sold versus your ending inventory. But if beginning and ending inventory are the same, then both methods will result in the same result. Okay, so if there is no beginning inventory, well, again, you could have no beginning inventory, but ending inventory, therefore causing a change in inventory. Therefore, that doesn't work. There is no ending inventory. Well, the truth is that you could have beginning inventory with no ending inventory, therefore having a change in inventory. That will not work. Uh, and the third one, C, there is no change in inventory level. And that's the only situation that this will work. But let's look at uh, the last one. There is no variable overhead cost. Well, the issue here is that won't work because you need to look at variable and fixed costs. So by default, C is the correct answer. 58, an example of a cost activity pool is. Now, a cost activity pool is basically a category that you set up total cost of. And let's look at the possible answers. Machine hours, that's really a cost driver. B, setting up machines or setup time, that's an accumulation of cost. C, number of setups, again, that's a cost driver. D, number of inspections, cost driver. So the only one that's at an actual expense that could create a cost pool is B. 59. Which of these best reflect a distinguishing factor between a job order cost system and a process cost system? Here, we're looking at assembly process versus unique job orders. So what you would look at is that a process cost system being that having probably a bunch of different departments, okay, versus a job orders cost system having separate projects, okay. So let's look at the answers. The detail at which costs are calculated. They should be no different. It's just how you categorize them. The time period each covers. There should be no difference there either. The number of work in process accounts. That's where they differ, because on one you're dividing it by departments, the others you're dividing by specific projects. But let's go on to D. The manufacturing cost elements included. There should be no difference here because you're using effectively the same type of cost. So by default, C is the answer. 60. Identify which statement below about currently attainable standards is false. Okay, so what's the key word here? Attainable, I think. So which statement is simply not attainable? Okay, that's the answer that we're looking for. Okay, they allow for normal spoilage and non-productive time. Okay, well, the truth is a standard or a budget should allow for that. Okay, that should be incorporated. So that's really a statement that's true and not false. B, because they allow for waste, they usually result in favorable variances. The fact is that waste is a natural part of a process, and therefore they would not necessarily result in favorable variances, and therefore this could be false, but let's go on. They represent projections of what will probably be attained. Well, they wouldn't be doing that if they didn't think that was true. And so this is a true statement. Employees usually view these goods as reasonable. Well, these goals as reasonable. The truth is that's subject to debate because sometimes the people that establish these budgets get too greedy. But if the company gives the employees an opportunity for feedback, they might argue back and get something more reasonable because obviously they have to buy into it. And so I think that the most credible answer is B. Job costs are incurred. Okay, I think 61 means joint cost. Okay, and so this is a situation where you're producing several products with the same similar cost or same cost. So let's look at the answers. Before the production process is started. Well, actually, no, that's not true. That's initial start of production, before individual products are separately identified. That certainly sounds true. After the split off point, but before the process further decision. Well, uh, actually, joint costs are before split off. Okay, so that's not true. And then after the process further decision. Well, actually, these joint costs are incurred before. So we've eliminated 3 and we're back to B. 62. The blank is not one of the 3 major financial statements. What is the key word here? To me, it's 3, because there's actually 4 major financial statements, but there's 3 that are more important than others. The 3 being the balance sheet, income statement, and retained earnings. But here, the key here is that this is a tricky question, because historically there's used to be 3 statements: balance sheet, income statement, and statement of retained earnings, and they've added the statement of cash flows that was not nearly as adopted in the past, but during the current economic times, the statement of cash flows has taken more importance, and actually it's taken on more importance than even the statement of equity flows. And so in the order of importance now, the remaining 3 financial statements are balance sheet, income statement, and the statement of cash flows. And by default, the statement of equity position, which is the statement of retained earnings, gets eliminated. 63. Identify blank our profitability ratios. Well, obviously we're looking for ratios that are that indicate profit. And a gross profit rate and return on sales. Well, that certainly sounds like profitability indicators, but let's go on. Dividend payout and rate of return in investment capital. Again, these have to do with valuing stock and things that investors look at as far as investing in the company's particular shares. Earnings per share and dividend yield. That has to do a lot with the value of the stock. Price, earnings, and current ratio. Again, price earnings have to do with valuation of stock, and current ratio have to do with liquidity. And so we're back to A as far as the profitability ratio. Final question, 64, on accounting. Which of the following statements is false regarding Sarbanes-Oxley? Now, here the key word is obviously Sarbanes-Oxley. And remember that back in the days of Enron, there was a lack of transparency, and a lot of that issue was that they found that there was a lack of independence. Arthur Andersen was doing both the internal and external audit. And so they really were, a lot of the thrust of Sarbanes-Oxley was to force more transparency and more independence. So let's look at answers that would be false. The Act calls for increased oversight responsibilities for board of directors. That's certainly true. The Act has resulted in increased penalties for financial fraud and by top management. That's certainly true. The Act calls for decreased independence. Well, do we need to go any further? Okay, that certainly totally goes against the grain. But let's look at D. The Act is meant to decrease the likelihood of unethical corporate behavior. That's certainly true. So I think we can now feel comfortable with C. And then there's only one economics question. When drawing demand and supply curves, economists are assuming that primary influence on production and purchasing decisions is. Now, what's the key word here? I think the key word is primary, because let's look at the answers. Price. All supply and demand curves are based on price and quantity. The cost of production. Well, when we're looking at supply, that's very relevant, but it's only one factor. The overall state of the economy. Well, that is one factor, but quite honestly, it's one of many factors. Consumer income, very relevant, a very important concept, but only one of several factors. And that's looking at actually the demand from a macro standpoint, not micro. Real GDP is also just looking at it from an aggregate demand, a macro concept, not supply. So C and D and E have only to do with demand, but not supply. Overall state of the economy is just one factor to consider. Cost of production only deals with supply. So back to the keyword primary, I think price is going to enter into the equation in both supply and demand in all cases, whether you're looking at macro or microeconomics. So I hope this video has been helpful to you guys.